We've all heard from somewhere or the other that we should invest to grow our wealth. But once you actually decide to take that first step, it can be quite confusing to know where exactly to invest. It's interesting because when I first started, I felt like there were so many options to invest. But when I actually wanted to put my money in, I felt like I was out of options. You may have thought about investing in FDs or mutual funds, but are they any good? What are the other options out there for you? Let's deep dive into it based on your current financial stage. I've split this video into 3 stages. Stage 1 is if you have high interest debt, which means if you have any debt that is more than 7% per annum in interest rate, or you're living paycheck to paycheck. Stage 2 is if you don't have any high interest debt, but you're just getting started and don't have any savings. Stage 3 is if you've completed stage 1 and stage 2 and you're now ready to start investing. Now feel free to watch the entire video or skip ahead to the stage that you're currently in. We won't spend too much time talking about stage 1. Stage 1 is where you have high interest debt, which simply means that at some point you had to borrow money to make ends meet. In other words, your spending was greater than your income. The simple remedy is to have a budget, sit down and figure out how much you're spending and how much you're making. If your spending is less than what you make, then you're absolutely fine. But if your spending is greater than what you make, then that's where we have a problem. You'll have to sit down and create a budget, figure out exactly what your income is, and figure out exactly where you're spending that money. There are only 2 ways out of this. Either figure out a way to reduce your expenses to bring it below your income, or find a way to increase your income. That can be going to your boss and asking for a raise, looking for better job opportunities, or taking up some freelance gig. Once you actually start making more than what you're spending, then this is when you need to make it a point to use that extra amount, that extra income, to be saved into your account. Now you don't have to go and open any new account. If you have a savings account, move it there from your current account, or if you just only have a current account, that's fine too. Just save the money there until you reach 1 month's worth of expenses in that account. What that means is that if your monthly expenses are 1,500 dirhams, you need to have 1,500 dirhams as a buffer in that account. If your monthly expense is 10,000, then you need to have 10,000. Once you have that 1 month's expense saved up, then you're in a good position to attack that high interest debt and pay it off as soon as possible. Now there are a couple of caveats to this. The reason we are first of all saving that 1 month expense is because emergencies do happen all the time. It's inevitable. So when that does happen and you don't have this 1 month's expense saved up, but you're paying off debts, then what happens when you do have an emergency? You're going to have to go and pay on your credit card once again or take out another loan. And the second part to this is that if you choose to invest instead of paying off your high interest debt quickly and early, then whatever you're going to be making from those investments, which by themselves are risky, by the way, all investments are risky, then whatever you're going to be making from those investments are going towards your non-risky fixed interest rates that you have to pay no matter what anyway. So the best way to do this is have that small emergency fund saved up first and then attack your debts, the high interest debts, and then move on to stage 2. Congratulations and welcome to stage 2. You are now debt free, but you still only have that 1 month of emergency funds saved up. Our target is to get to 6 months worth of emergency funds. The reason we target to save about 6 months worth of expenses in your emergency fund is because not only might you have smaller emergencies like small fix on your car or your AC, but you might have larger emergency bills that might come up. Things like losing your job or maybe a hefty medical bill. When these emergencies do hit, we don't want to be in a position to go back into that habit of getting into debt. So for example, if your monthly expense is 1,500 dirhams, your emergency fund goal should be to have 9,000 dirhams. If your monthly expense is 10,000 dirhams, then your emergency fund goal should be 60,000 dirhams. So where do you save these emergency funds? Unlike stage 1, I highly recommend that you do have a separate bank account for this purpose. Now this bank account should be liquid, which means you should be able to have access to those funds without any penalties. There are 2 types of accounts that I personally use for this purpose. One is a relatively high interest bearing account inside the UAE. Accounts like the Mashreq Neo Plus savings account, which offers 6.25% per annum in interest, or the VO Bank personal savings account, which offers up to 6% in annual interest. The other route you can take is to save the money in an account like the ADCB Millionaire Destiny savings account or the Emirates Islamic Bank Kunuz savings account. Now, these accounts offer a small profit sharing, which is kind of like an interest, but the rates are much lower than 6 or 6.25%. But they also do offer raffle draws where you have the opportunity to win millions of dirhams or cars or any other prizes. Now, it doesn't really matter which of these accounts you choose to go with. I leave links to all of these accounts that we discussed down in the description below. Just know that some of them are just regular links to the website. Some of them are affiliate links that may benefit me without any additional expense to you. And some of them actually do benefit you as well if you use them. So make sure you check them out if you decide to go with one of these accounts that we are discussing today. So as I was saying, I do like these accounts personally, but it really doesn't matter which particular account you go with. I would recommend an account within the UAE. I would recommend that it be liquid, which means you have access to the funds at any time without any penalties to you. Before we move on to stage 3, I just want to make a quick note that once you do have 3 months worth of expenses saved up as an emergency, you can start your stage 3 investing as well, but make sure that a portion of your savings continue to go towards your emergency funds till you reach that 6-month target. Stage 3 is the fun part. You're actually going to start investing now. Now, it does require a bit of a deep dive, and I want you to put your thinking caps on. Now, before you start investing, I want you to really think about 4 points. The first point that I want you to think about is, are you investing for the short term? This could be saving for expenses that you know are coming up within the next 1 to 5 years. This could be things like buying a new car, buying a new home, maybe you're planning to get married, or maybe you want to save for your child's education. Why this matters? Because you don't want to be going heavy into cryptocurrency investing or equity fund investing if you are planning to remove those funds within the next 1 to 5 years. The second point that I really want you to think about is long-term investing. This, as it sounds, is for long-term goals. This could be financial freedom, retirement, and so on. Long-term investment allows you to take that extra risk to invest in equities, which means the stock market, and therefore earn you much better returns. The third thing I want you to think about, and this is very important that most people don't think about, is the geographical location where you intend to execute these goals. For example, if you plan to save money for a wedding in the next few years, but you plan to get married in India, then it might make sense to send that money into an FD right now in India in an NRI account, take advantage of tax-free returns, but also take advantage of higher returns from the FDs in India as compared to the savings accounts here in UAE. Now let's take a look at a more long-term example. If you do plan to retire in India as opposed to retire in any other country, including the UAE, how would that make a difference in terms of the geographical factor? Let's say you invest 100 dirhams in India. You earn 10% ROI on that. It is now 110 dirhams. But your rupee has depreciated by 10% as well. So when you bring it back into UAE, not only have you lost out on the inflation increase, so your 100 dirhams now is worth less than what it was when you invested, but also because you've lost out on that 10% increase from your investment, because the currency is now valued at a lesser rate, that can have a big impact. And that's where thinking about where you want to execute your financial goals has a major part when you think about investing. And the fourth point I wanted to think about before you start investing is, how much are you planning to invest? This can be a lump sum or a monthly figure, but how much are you planning to invest at that given point? The reason for this is, it wouldn't really make sense using certain platforms if you're having to pay a bigger chunk in transfer fees and even execution fees. That may not be such a big problem if you are investing bigger amount. As a general rule, I'd like to cap it off at $1,000. Depending on the amount that you plan to invest, investing in certain platforms can be way more beneficial than some others. And we're finally here. Where do you actually invest? Okay, here's my thoughts. If you're planning to invest in the short term with an amount of less than $1,000, I would recommend sticking with the Mashrak Neo Plus savings account or national bonds. They are locally available, you're not risking currency risks, and you're not sending it to the US and paying hefty transfer fees. Small amount, short-term goals, I would stick to the basics. Again, all these accounts are linked below, so if you're interested, check them out. If your investment goal is a short-term goal and your each transaction value is more than $1,000, then I would recommend that you go invest in the Interactive Brokers platform or IBKR. Pick one of the debt or money market funds that are available to you and invest in those ETFs. The reason I came up with this $1,000 threshold is because think about it. If you're sending $100 and you're paying $20 in transaction fees to deposit the money and then $20 to withdraw the money, that's $40. That's 40% of your investment gone just in fees. But if you're spending $1,000 and you're spending only $40, then it becomes a much more reasonable charge for you to digest. If your investment goal is a short-term goal, but your expense is going to be in India, let's say you're trying to save for a wedding in India, then I would recommend sticking to the basics. Invest in an FD or an RD in your NRI account, or if you really want to push it, you can go for a debt or money market fund in the Indian mutual fund market. These should give you returns of anywhere from 6% to 10%, and they're easily accessible for you to withdraw and use in India. If your investment goal is to invest for the long term and you have a transaction amount of $1,000 or more per transaction, then again I would invest in IBKR. But this time we are not doing a money market and debt ETF portfolio. We are doing a more balanced equity portfolio. I'll be sharing my personal investment portfolio allocation very soon. So if you're interested in checking that out, don't forget to subscribe and turn on the notifications. Okay, if your plan is to invest for the long term but you have less than $1,000 per transaction, then I would highly recommend to use the platform called Sarva. I've made a lot of videos about Sarva in the past. If you're interested, feel free to check them out after this video. But basically, you can invest in a locally based company. Sarva is based in the UAE, but you do have access to invest in the global stock market. So that would hugely reduce your deposit and withdrawal fees just because they're based here, but still give access to all of those funds. If your investment goal is long term, but you definitely plan to, let's say, retire in India, then it might be worth considering using the power of the Indian stock market. Invest in the mutual funds in India. Make sure you pick a good big fund house like HDFC or ICICI or SBI. Pick the funds that are suitable to your goals and your requirements. Invest in 4 to 6 mutual funds that have a mix of large cap, mid cap, small cap funds, but also are value, growth and momentum oriented. So you have a mix of everything in your portfolio. And historically speaking, you can in fact make a slightly better ROI by investing in the Indian market, which gives about 12 to 14% as compared to the 8 to 10% you get from the US market. But as I said before, you do risk that currency fluctuation. So make sure that the funds you send to India are not affected by any depreciation in the rupee. Now, before we move on to stage 4, which is a bonus stage, I just want to quickly mention that I personally invest both in the Indian mutual fund market and in the US ETFs. So it's not that you have to choose one or the other. The only point I'm trying to make is that you have to think about these factors and make an informed decision. Don't just YouTube or Google where should I invest and pick whatever comes up first. It is very important to think for your own, because everyone's personal finance is personal to them. As I said, I will explain the thinking behind my investment portfolio in an upcoming video, so stay tuned for that. Okay, let's get into stage 4, the bonus tips. These are going to be short and sweet. Tip number 1, always set a goal for your investments and invest that every single month without fail before you start spending your money. Don't invest what's left over, spend what's left over. Tip number 2, you already regularly invest that goal figure towards your long-term investments. What if at the end of the month, after your expenses, you still have some money left over? You have a few options with this. You can either use these funds for charity, you can use these funds to buy something nice for yourself, or you can use these funds to invest in something that is highly risky like cryptocurrency. I don't want you to get into crypto as your main go-to investments. But having said that, if you look at the past few years and what crypto has done, I wouldn't be telling you to not go into cryptos at all. Just be cautious and be sensible when it comes to crypto investing. I personally have been investing regularly in the crypto market and I use BitOasis or Binance for my crypto purchases. Tip number 3, just get started today. It doesn't matter if you feel lost or behind. Just start somewhere. It doesn't matter where. If you keep procrastinating, that will only lead you to keep delaying your journey. Tip number 4, and it's a very important tip. Once you start actually monetarily investing, I want you to also invest some time and or money into your own education in terms of investing. I have an educational background in finance. I've been working in finance for over a decade and a half, and still there is something new I learned a couple of weeks back. I've been investing in ETFs like the SCHD and VOO, which is US domiciled, and I recently found out that it would be better for us as Indian NRIs to actually invest in Irish domiciled ETFs or UCITS as opposed to US domiciled ETFs like the VOO and SCHD, because these UCITS not only offer better tax withholding on your dividends and other payments, but they also offer huge benefits to your beneficiaries once you pass on in terms of estate tax and so on. So make sure you invest a decent amount of time and or money in educating yourself, because that can go a long way. Now check out this video if you want to learn more about Sarva, or check out this video. I'll catch you in the next one. Take care.